What up, everybody? It's Lonnie here with Charts and Labs here on Tuesday, December 23rd for a new video for you. We're going to change the pace a little bit. But before I get started, I want to make sure that everybody remembers this is not financial advice. I'm not a financial advisor. And by no means do I have any certificates saying that I'm the smartest person in this uh, sector. But I do have some experience, and I like sharing that with everybody to help give them some familiarity with this kind of stuff and personal wealth building so that they can partake if they feel comfortable. So if you're following the channel along at all, you'll know that I've been doing some options trading and some crypto trading, which is a lot more of the higher risk, higher reward kind of plays. And we're gonna change that pace up a little bit. We're gonna jump into something that I really like talking about that is a lot more boring, and that's dividend stocks. So when you look at dividend stocks, the biggest thing that you always look for is what is the dividend, how much is it. But the best way to gauge that is if you come across and you're looking at the information on them, is this dividend yield percent. And you got to think, if we know that, and inflation is between 2 and 4% a year, it kind of fluctuates, and I don't even know if they ever report it correctly. And then the value of the dollar also goes down and all that stuff. So, kind of a nice benchmark is that you need to at least maintain 4% growth, especially if you take into fact consideration that your savings account is giving you less than 1%. Um, some bond type investments are going to be closer to like a 4% yield as well. So that's kind of like the standard that we want to look for with these dividends giving you at least a 4% yield in the dividend. And then also that the stock itself is hopefully growing in value. And that'll kind of vary depending on which one you're getting at. There are different couple types of dividend plays that you can do because they have ETFs that are comprised of multiple dividend paying stocks. So you get a good array and some consistency throughout the year because most dividend stocks are going to pay you quarterly based on their earnings report, based on their yield and set, or how well they did, then they pay out a dividend. There are a few stocks who pay monthly dividends, and those guys compound really nicely, like ORC that we have highlighted right here. The reason that their dividend yield is so high is because they do monthly. Then there's some other ones that are what they call yield boost or like a high yield or boost earnings ETFs. And what these are is, the Round Hill guys and the Granite Share guys, what they're going to do is they're going to take your money that you have invested in this and they're going to do options trades for a week and then distribute the earnings from them. And that's why these guys have some crazy high yields, is because they have weekly payouts. They're doing weekly contracts paying you out based on the volatility of the individual stock. Like TSY is Tesla, COIW is Coinbase, Palantir, PLTW, NVIDIA, NVDW. So what they're doing is they're making the options plays for you so you don't have to do those high risk options plays, and then they're going to pay you weekly. The reason that this yield gets very high is not because of the 1 week payout, but it's if you leave it in a drip type a structure where that is automatically going to be reinvested every time that they pay you, so that every time it's going to compound on top of each other. That's what I always recommend doing, is to get into these set it and forget it kind of plays, and then let it just reinvest and build on itself. That way, it's compounding interest, and we all know the strength of compounding interest on how fast that can grow. Typically, when you're looking at dividend stocks, the ones that are higher paying ones typically are geared around real estate, or like oil and gas is a big one. But even in those levels, some of these guys that are very high paying, like Cornerstone Total Return is a tricky one. They have very high yield, but you gotta watch their NAV, the net asset value, because a lot of times if what's going on in the market isn't going in their favor, what they end up doing to maintain that yield is they're paying you back out of your own money. So that eventually they'll run out. But on short downturns, they end up losing really bad. So anytime you get any of these dividend stocks that have a yield over I mean, over 7% is pretty high. Anything in the double digits, you don't have to necessarily watch them like they're gonna stop and you're gonna lose your money. But it is something that as an investor you should be getting the investor updates, whether it be an email or an actual mail letter, or you just got to check in on them every now and then and check the news. And there's ways to check on this to make sure that they are not ending their dividend, because they become uh, with that higher yield, they're at a higher risk of not being able to pay it long term. So it's not like a complete set it and forget it. It's a set it and kind of just check on it periodically type of thing. But there are some dividend aristocrat stocks that you can also get in that are 100% hands off of just throw your money in there and you don't even have to look at it. It's just going to automatically build. And those guys are like these ones that are in this 4 to 8% yield range. Verizon and AT&T are two that stick out very high. AbbVie Inc. is a medical company that has been considered a dividend aristocrat for a long time, but they only have a 3% yield, so they barely keep up with inflation, but they also grow pretty well as an individual stock. So, kind of the cool thing about talking about those is because if you look at like the one that's like that, uh, the weekly yield, that is a way to be like, hey, I want to start compounding some money. I want to make some money. You throw it into one of these guys that has this weekly yield, and while if you don't have the familiarity with options to make these pivots and these plays, the cool thing about Tesla being so volatile, especially lately, as things are ramping up, whether their robotics is going to take off and are they making enough profit, um, their yield right now is insane on these guys, and um, they themselves don't move very much. They are getting a lot of action right now because of Tesla's volatility. People are kind of coming back into them, um, but because of that, you don't really worry about losing this $6. But what you're looking at getting is, $14 a year is kind of what it's saying right there because let's see if we can get this to show us the dividend. So we do daily. Is it going to show me there? No, doesn't show. I've been following them and they are paying weekly, pretty consistently. And I want to say it was like 53 cents. I just saw it and I don't know why they got rid of it. But 53 cents per share is what it ends up compounding out to be. So those are really cool options to do because not everybody wants to do the options trading and make these plays. They don't want to have to stare at the charts all day and look at. Let's see. Let's go over. You don't want to have to go in and try to follow, AVGO, or let's actually do Verizon because that one's a good dividend. So Verizon is a great dividend stock, and if you invest in the company, you're going to see that this is not very crazy compared to Tesla. So Tesla has very erratic moves, and then Verizon is a lot more stagnant. So you're going to look in your portfolio and you're going to say, man, Verizon's been $40 forever. It doesn't do anything crazy, but you're getting 65 cents per share paid to you every 3 months, and then that builds up and it works out to be 270 a year or whatever, and you get your 7%, which outpaces um, the inflation and all that. And that's why these plays are good to consider and keep in mind because while there's plenty of opportunity to make money, anytime that there's a higher risk, there's a higher reward. And then if you remove a lot of that risk, you can get a lot of the reward. But the reward with these ones is not in taking the individual risks consistently. The risk is you're giving them the money and they are now gonna build on it. So and give you this yield. ORC is one who is in the mortgages, so they're sensitive to the interest rates. You have to watch them on that. Alexander is New York real estate. As the real estate market is good, they pay out a great dividend. 8% is phenomenal. Giving you an 8% guarantee, not guaranteed, nothing's guaranteed, But giving you 8% consistently is, money while you sleep is the way to build wealth. And so if you're active in it and you're following these and you're picking up the charts and you're making the investments in some of these, in like the Nvidias and Teslas and Amazons and Googles and Intels and AMDs, those guys are going to have potential to, double your money in 5 years or 2 years or whatever. And but there's also the chance that they don't. So that risk and that reward ratio is there. Whereas if you jump into these dividend stocks, they are, a lot less risky, a lot less reward, but consistent in your stacking. So kind of the play that I personally like to do, that I recommend to a lot of people, is put the majority of your portfolio in the dividends, and capture that yield, and let it compound. And then while you're learning, whether you're investing in individual shares and you're buying, stock, or if you're doing the options trading, keep that as your smaller position, and then reward yourself when you make the profit, is to put it back into your dividends as like your store of value. Is kind of the strategy that I like to implement. Is you build it up with the options and then put it into um, the dividend payer. And as we can, they're all on the bottom. So dividend, these guys pay monthly, which is really cool. ORC is Orchard Island Capital, and they're a mortgage-based company doing right, lending and stuff on that, and they're making enough. They've been holding this dividend for a long time. Um, I think it went back like at least 8 or 9 years that I saw. It was before COVID. They were still paying this, so they have had a little bit of a trickle down from the highs because of interest rates being high. They weren't doing good, but as we're cutting interest rates, you can see that they're starting to go up again, and they were able to maintain their dividend all the way through the interest rates hiking to highs that we have not seen before. So now that interest rates are on their way back down, these guys will be able to make a lot more profit, and not have to risk losing their NAV, their net asset value, and maintain this dividend pay. So I really like ORC to build a dividend portfolio. CRF is a total return. These ones are goofy. Um, you can make money on them, but you have to be ready to pull out as soon as the net asset value starts deteriorating. When the market is in its favor, they're making money and you're making some money, but you have to be liquid with these. I wouldn't get crazy on them. But these guys are an interesting one because the volatility in crypto has led a lot of volatility into Coinbase, and they pay every week. So for every share that you own, like this week they got $1.34 per share that you owned, and this week they were only able to make 53 cents. So some volatility in it. It's not going to be consistent. You can't bank on getting the same amount every week, but if you leave it in there and you let it reinvest for a whole year, you're going to capture the ones where they get $1.30 or $1.50, and then it's going to average out to the ones that also get um, like 33 cents, and they don't do as well. And then Palantir, these guys, dollar 86 cents. These guys are doing really well consistently. But yeah, Tesla has had. It's still not showing me on theirs. I don't know why it doesn't want to show me theirs, but I always get the notifications when they pay it. Let's see what the news is on them. 16-cent dividend. That was. Huh, that's a much smaller dividend. So something to look at. There are yield boost, which are going to be higher risk but pay weekly, and weekly compounds quickly, so then you get a higher yield. But anytime you see a higher yield, you got to think that the more that the yield goes up and the reward goes up, there's more risk. Um, and and when you're building a dividend portfolio, make sure that you're outpacing inflation. Some of the ones like ABBV, um, which only had a 3%, at least they grow pretty steady. They're a decent growth stock as well. So you're getting the value of the company as well as getting paid in that dividend. So make sure you get your high yields, whether they be the ETFs and the boosts. You get a good mixture of your aristocrats. The dividend aristocrats are people who've raised their dividend every year for 50 years straight. And then mix in some of the ETFs to have a good balance of everything. Just watch your always keep in mind when you're doing your dividend portfolio is you're keeping track of your yield and that NAV, net asset value. If they start losing the net assets and then they are uh, bleeding out cash, they're not going to be able to maintain that dividend. And so, obviously, as long as you're getting it, that's great. But just be ready to not leave your money in there, because a lot of times a dividend stock, if they don't pay the dividend, there's no value in that dividend or in that stock with no dividend because they don't grow as much. They're very stagnant. And then typically, if they're pulling a dividend, something is going wrong. They're not growing anymore. So, things to consider when you're building your portfolio of wealth and being diverse. Playing options and playing in the higher risk tech stock, and you're playing in the cryptos. Don't forget to play it safe and get some of that passive money with the dividend players, and make money while you sleep is the Warren Buffett dream, right? So um, something to consider. Not the most exciting video because there's not a lot to talk about on the charts with these. There's not like I really gotta try to make sure I get in at an exact price. The whole thing is it's more of a time in the market versus trying to timing the market. When it comes to dividends, is the faster you start earning the yields, the faster you start getting the rewards. So if you got a lot of money sitting in a savings account not making you very much money, there's better stores of value that could be earning you a better yield in some of these dividend type stocks. And if you want to talk more about those, feel free to comment, message me directly. I could dive into some individually, but really the basics are pretty straightforward. You can Google them, you can search them, or however. If you want to ask me to go find you a bunch, I can share you my list if you want. Um, these were lists that I made a while ago, so they're not even up to date. I haven't touched this up recently to see if there's anybody who pays higher or has another range. But personally, I like to look for ones that have a 4 to 8% yield and build a good base of those. And then since I'm paying attention, I don't mind playing. ORC is one that I've had for a long time that I like playing and I keep adding to because it compounds monthly and I can see it building. Imagine having an account big enough that you have enough money into month, like whether they be in these higher yield stuff like the weeklies or the monthlies like ORC and maybe some other ones, and you're able to pay your mortgage with your dividends, and then whatever you work is extra money. Talk about building wealth is reducing your bills kind of thing. Look at dividends as a good way to build that passive income and build wealth while you're growing. And these are much safer than doing the options trading and the cryptos and some of the other more speculative assets like in the tech world. So I suggest everybody consider them and look at getting into some of these dividend plays. Yield is what you're going to getting paid yearly. So if you have $100 in ORC, you should earn close to $20 a year. Doesn't sound like much, but imagine if you had $10,000 in ORC and you were making an extra $2,000 a year and it paid for a vacation for you every year. Imagine if you had $50,000 in ORC and it was earning you $4,000. Uh, so yeah, it can, or whatever, 4,500, whatever. Math is hard, and but you get the point. Uh, build your portfolio, get that steady money, and keep grinding and adding, and pretty soon it starts compounding on itself, and it's a snowball effect. So build wealth, everybody, get rich, and live happily ever after is the goal for everybody. So sorry, this one is a little bit more boring. Dividends are boring, but earning money while you sleep is not.